Hey everyone, welcome back. If you're a business owner looking for smart, legal ways to reduce your tax bill, then you're in the right place. Today, I'm going to break down exactly how investing in real estate can help you keep more of what you earn. No complicated jargon, just actionable tips. And be sure to stick around until the end because I've included some valuable resources in the description below that'll help you continue your journey to financial freedom. Let's dive in. Real estate isn't just about building wealth. It's a powerful tool to legally lower your tax bill. Unlike other investments, real estate offers unique benefits like deductions, depreciation, and tax deferral options. And when done correctly, you can keep more of your business's hard-earned cash in your pocket. First, let's talk about depreciation. Even though property generally appreciates in value, the IRS allows you to write off a portion of the property's cost each year as if it were losing value. For commercial properties, you can depreciate the building over 39 years. This means if your property costs $390,000, you get to write off $10,000 each year, essentially reducing your taxable income and, in turn, your tax bill. Another powerful benefit? Mortgage interest deductions. Every time you make a mortgage payment on a business property, the interest portion can be deducted as a business expense. This deduction can significantly reduce your taxable income, especially in the early years of the mortgage when interest payments are highest. What if you could sell a property and buy another without paying taxes right away? That's where the 1031 exchange comes in. A 1031 exchange allows you to defer capital gains taxes when you sell a property and reinvest in another. So, instead of paying taxes now, your money stays invested, helping you grow wealth while deferring your tax bill. If you use part of your home exclusively for business, you may qualify for the home office deduction. This can cover part of your mortgage interest, property taxes, and even utilities, depending on the portion of your home used for business. While not directly tied to real estate investment, this strategy helps business owners lower their tax burden through real estate-related deductions. If you want the tax benefits of real estate without buying property, consider real estate investment trusts, or REITs. While REIT dividends are taxable, certain REITs can pass through tax benefits, which may include deductions similar to owning property. It's an easier way to add real estate to your portfolio and still benefit from some tax perks. To put it all together, let's look at a quick example. Imagine a business owner who has a taxable income of $200,000. By leveraging these real estate strategies, depreciation, mortgage interest deductions, and maybe a 1031 exchange, they could save thousands in taxes. Even a $10,000 reduction in taxable income could lead to significant tax savings. While these strategies are powerful, remember that it's essential to stay compliant with tax laws. Improperly claiming deductions or mishandling depreciation could trigger audits or penalties. Always consult a tax professional before making these moves. Real estate offers some of the most effective legal ways to reduce your business taxes. From depreciation to mortgage interest, each strategy can keep more money in your business. And that's it. Real estate can be a powerful tool to legally reduce your business tax bill, and I hope these strategies give you some inspiration for your own tax planning. If you're ready to dive deeper, I've added some valuable resources in the description below to help you continue your journey to smarter tax savings. Thank you for watching. If you found this video helpful, don't forget to like, subscribe, and hit the bell icon so you never miss out on more ways to empower your business finances. See you in the next video. Thank you.